This video is created in partnership with our friends at Walkthrough. They are a registered investment advisor with the SEC who provide personalized financial advice. And they are a lot like a human financial advisor, except way cheaper and focused on making sure you actually understand what is going on. Check them out at www.walkthrough.co. If you've been curious to learn the basics about investing, this video is for you. Maybe you've had questions about what investing even is, what investments generally are, and why diversification is important. At Denary, we're Ivy League trained and passionate about financial literacy. We have your back on all things finance and ultimately want you to have the tools to reach your financial goals. Think of this video as an overview of Investing 101 as part of our investing series. And if you have questions or other topics you'd like to learn more about, let us know in the comments. Quick disclaimer, this is not legal, tax, accounting, investment, nor other professional advice. Consult an advisor and do your own research for your individual situation. So, what is investing? Investing is an action you take with your money to make it grow. You can invest your money in things such as stocks, bonds, and real estate. These are called assets, and you buy them in the hope that they will appreciate or gain value and make you a profit over time. There are many types of investments like collectibles, art, starting your own side hustle, and many more. Today, though, we're going to focus on stocks, bonds, and housing, since those are the most common investments that everyday folks make. In this video, we are not going to be talking about more speculative bets like crypto. What we mean when we say speculative is that it carries a higher risk of permanent loss, so you could lose all your money, which is what happens with gambling. So, how is investing different from saving? This is a totally fair question. Investing and saving are not the same thing. You might hear some people say that you can't save your way to long-term wealth, the same way that you can with investing. So, saving is the first step that you take where you spend less money than you make and then you have some extra cash sitting around. You might put this money aside or even put it in a high yield savings account. On the other hand, investing is where you take the next step after you've saved your money. This is where you put your savings to work. And putting your money to work is what allows you to build a wealth. Let's look at an example to see how saving and investing differ. Let's say you have $10,000 saved in a savings account, which gives you a 0.5% interest annually. After 30 years, you would have under $12,000 sitting in that account. But if you had invested that money in the stock market, averaging about a 10% return every year, you'd have almost $175,000 instead, a 15x difference. Is investing in the stock market gambling? Some people might say that investing in the stock market is like gambling. That is not true. Let's break down why. Number one, yes, both investing and gambling have some risk involved. And I get it, risk is scary, but there's a little bit of risk in everything in life. After all, without some risk, there isn't a reward. The point, though, is that a little risk is okay when you're being smart about the risk that you are taking on. You just need to decide for yourself how much risk you are willing to take on. Number two, over the long run, as an investor, you can expect returns. We know that the stock market tends to go up over time. This is not the same case for gambling. As a gambler, your concern is with the short term and you can only hope for a return. The difference between being the house and the gambler is that the house wins on average in the long run because of math. So we don't actually call it gambling. The same is largely true of the stock market. And number three, when you invest, you are paid for taking on the risk. In fact, when you invest in the stock of some companies, they actually pay you for owning a share of their company in the form of stock dividends. Before we can talk about how to invest, we should talk about two main investments that get our money to work for us. These are stocks and bonds. Stocks are very small parts of companies. You might sometimes hear owning stocks as having equity in a company. So, when you own stocks, you own a part of a company. Historically, stocks have grown at about 10% every year on average, but they are more volatile. Bonds, on the other hand, are loans that you make to different groups, like companies or governments. So you give them a loan when you buy a bond, and over time, those groups pay you back the money that you lent them, plus a little bit of interest, about 6% annually on average. Stocks and bonds are assets, and we usually combine them when we invest. Why? Because historically, as one group goes up, the other goes down slightly. This helps us smooth out our growth over time. Marrying stocks and bonds together has been one of the main engines of wealth creation throughout recent history. How to choose stocks and bonds. By law, I cannot tell you to invest in a specific stock, but I also don't believe that most of us can handpick stocks and day trade to generate wealth. And that's not just because there are people whose entire jobs are focused around research and trading, but because research shows us that you can do just as well or even better by investing in passive, low cost index funds. Index funds essentially are collections of stocks that follow a particular index, like the popular S&P 500, which follows the 500 largest companies in the US. The balance between the companies follows a well-established rule called an index and is actually not actively decided by humans. That's why they are passive and therefore cheap. It's really hard to figure out what makes a given company a good investment and then choose it as an investment. You have to think about a lot of things like profits, competitors, market trends, future demand, and a lot of other things. Again, there are people whose entire jobs are doing this type of research for individual companies. The great news is that index funds solve this problem for us because when we invest our money in hundreds or thousands of companies and then further invest across other assets like bonds, we don't need to think about the failure or success of a single one. Thus, index funds allow us to diversify our investments very easily. What is diversification? You may have heard of something called diversification. It's in line with the expression, don't put all your eggs in one basket. In the investing world, diversification is something important to think about because you may not want to put all of your money into one investment or one particular stock. Why? Because it can be too risky. That is why it is so important to spread your money across lots of companies. One of the reasons why index funds are so great is because they spread your money across hundreds and sometimes even thousands of companies around the world. As you can see in this chart, more stocks in a portfolio can decrease the level of risk with an investment and make it less volatile. When is a good time to invest? Choosing to invest depends on your individual circumstance, but sometimes people worry about buying into the market at the wrong time. Here is the simple and general rule that is hugely supported with academic research and over 100 years of data. Anytime you have extra money to invest it now. And after you buy, hold, don't sell. The market will probably go up and down. That is just short-term noise though. Remember, you are here for long-term growth. This very simple rule gives your money the longest possible time to grow in the market and to work its magic thanks to compound interest. Remember, time in the market is much more important than timing the market. That's it. I know this was really high level, but those are the basic principles of investing. Hopefully you feel good about them at this point. If you have questions or topics you want us to cover in future videos, please drop them in the comments below. Also, make sure to reach out to our friends over at Walkthrough at support@walkthrough.co and consider trying out their service to get a free personalized financial plan. Until next time.